Okay, so welcome to this live webinar broadcast on Monday, February the 16th, 2015. Hope you've all been having a great time trading over the course of the last few weeks. A fairly light economic calendar most days this week. It's a it's a US holiday today. I think it's President's Day. So we're going to expect a light New York session, and the London session doesn't seem to have sparked a lot of interest today in any case. Heavier data in the middle of the week, though. Wednesday, look out for Bank of Japan monetary policy statement. They have been quite aggressive in intervening in the yen markets, and usually around the time of those statements, quite often preceding it, right? So eyes on that. The big data on Wednesday, though, is UK claimant count. That's the equivalent of the UK NFP. It does spark a lot of volatility, particularly as you might expect on the cable crosses. We have the release of the Bank of England voting pattern, and as well the release of the FOMC meeting minutes on Wednesday. And then there's that whole underlying and overlaying theme in the market of Greece and Greek debt, and potentially a Greek exit from the Eurozone. All that's kind of coming back into the fray. So there's plenty there from the calendar, and as well more fundamental themes where you might expect at any time that things could really kick off. What we're seeing in the market right now, though, across most pairs, across multiple pairs, appear to be what I term holding patterns. So, we over the course of the last few months, and not just the last few months, but particularly in January, right? We saw moves on pairs which went for thousands and thousands of pips. And when the price has moved that far, when there's been that much of a significant change in the price itself, then you can expect that there's going to be a bit of a stall, and there's going to be a bit of a hold as the market makes up its mind what it wants to do. And after that, you're going to see a retracement, or you're going to see a follow through to the momentum that was established in that month, and that's what we're looking at on a lot of pairs at the moment. So let's start off, and when that's going on, it becomes even more important to be trading off of solid support and resistance levels, areas where you would expect pip perfect touches, pip perfect reactions, and to be able to pick off those levels cleanly, and consequently have very, very clean trades off of them. All right, so we're looking at a handful of pairs this morning, and so I'm going to run through some general analysis on a few pairs, and we're going to mark some levels on a few others, and I'm going to fill you in on the active trades that we have running right now and the reasons for those. So first off is the Euro USD. From the beginning of the year, so we're talking about the 1st of January, she moved almost 1,000 pips to the downside, right? So she's been from 121 down to 111. And so a perfect example of what I was describing earlier on about, a strong move, and then you're going to get a holding pattern, and that's exactly what's happening over here on Euro USD as the market tries to make up its mind about the future of the Eurozone and the general health and economy itself. As far as the technicals are concerned, we have no reason for believing that, here's the downtrend that's been fairly well established, but we have absolutely no reason for believing that downtrend is over. What we're seeing from a structural point of view are resistances on the instrument, and those resistances were breached as the price collapsed. And we're not seeing at the moment support structures being established, right? So, downtrend and a wave with resistance, and it tends to look like that. And when you're getting a bull trend, you have supports established, and it tends to look like that. And when you're looking at this chart, it's not looking like this. Now, There is a tendency amongst a lot of traders that you want to kind of preempt a move and thinking, hey, there's going to be a new bull swing beginning from here, and I want to get on board early. But quite often you can get hurt doing that, and so it's always better just to wait. And if there is going to be a bull trend, there's no problem with missing the first 1,000 pips in that bull trend, so long as you catch the greater part of the next 1,000. And that always tends to be a more sensible way of thinking. So as far as we're concerned structurally on the Euro USD, the bear trend is very much intact. And what we have here is a block down towards the 112 price handle. And so technically, the way that you want to interpret this is that there is a bear trend. It's a bear wave, and that bear move is being supported at 112, right? So this isn't a support in a bull trend. This is a support in a bear trend. And when you have a support in a bear trend, when that support is breached, that tends to signify a continuation in the pre-existing momentum. And therefore, I'm looking at that block on the 112 and I'm saying, hey, I'm still very much interested in the shorts on the Euro USD. So long as she remains above that block, I will consider that she's in counter trend corrective territory here. And if you like playing the counter trends, anytime she dips into that block and you get a H1 or a H4 bullish bar off of it, you just buy using the size of that bar in order to determine your risk and stop, looking for a further corrective move. But once that block has been breached, I would very much suspect, and I don't think we're going to see a fast move down in Euro USD, but we might see that kind of stepping, grinding move down, and just gradually she will move lower and lower and lower. I'm sure there's a few hundred pips to the downside left in her yet, potentially pushing for the 108, 107 price handle in the first instance, and then after that we'll just have to see how much further it is that she wants to go. So we have an intermediate support at the 112 price handle. If you're looking for counter trend rallies, you're going to be looking for bullish bars off of that, and you really have no choice but to consider them counter trend until you have a technical support structure developing, which we don't have right now, but a breach of that, and that spells continuation to the downside. Just beware that the monthly open price was around about the 112.50 handle at the beginning of this month. So above that, the monthly candle is bullish, and below that, the monthly candle turns bearish. Below 112.50, we also have the direction of the flow on our side, and hopefully a little bit of wind in our sails. All right, let's say that she does rally north. I think that the area that you're going to be looking at is going to be leading somewhere up to the 117 price handle. And as well, there is a support wall that goes something like this. I like see how the arrow was drawn. Pretty good on that, right? So just connecting the lows there. All right, and so if she does rally up towards the wall, that would be of interest, but particularly if she reaches the 117 price handle, anywhere above the 1660 area. So we're kind of looking for a move up through that consolidation area. And if she does rally as far as that, now here's the thing, I'm looking at the January monthly bar and I'm not seeing the price pushing back into the 20s. So any sign of failure up to the 17 price handle, you get a bearish bar off of that on a H1. H4, I'd say comfortably. Say the price pushes that far, and then you get a daily bearish bar, right? I think that would be a good trigger condition. I think it would be a good trigger condition, and then you can start loading up and saying, all right, we're getting ready for the next swing south, right? And I think that's probably, from a terminology point of view, I guess that's quite an important uh, for lack of a better term, phraseology to be using. Um, so we're looking for the next swing down still, and structurally, there's no reason actually, except in a counter trend uh, theme, so to speak, to be thinking about long. So we're still thinking shorts. It's just a question of where that swing is going to begin from, and what we would consider to be the trigger condition for that. Okay, Mr. Black Cat. What about 1640, 1650? Not strong enough to keep euro below 1700, right? So I'm not kind of trying to. I'm kind of using rule of thumb here rather than a precise level, right? So one of the things which I've noted is that the threes and the sevens tend to be more significant than the double O's, right? The threes and the sevens tend to be more significant than the double O's. So, if someone's if we're looking at a micro level, if someone said to me, "Hey, the price is at 118," right? And would you expect the price to react there? I'd kind of be saying, well, I'd expect a reaction at 117.70 or 118.30, right? And it's just something that I've noticed over the course of the last few years, last few years for a long time, that the threes and the sevens tend to be more significant. So failure ahead of 117, and you might get that stall early. You might get that stall at 1640, 1650, whichever block you might be looking at for some kind of structural resistance. That's okay. But I would expect the failure before the 17 handle or at the 17 handle. Is it anything to do with fibs? No, I don't use Fibonacci. It's just way too discretionary, right? So I think the best way to apply technical analysis is that when you learn a technical analysis methodology, when you have two people looking at the same chart, marking the same wall or the same block, it's important that they arrive at the same conclusion. And I think that defines a good technical analysis methodology. When you have a methodology like Fibonacci, it's just way too discretionary, and it's the same trigger as kind of giving someone a buy signal, and the same trigger as giving someone a sell signal at the same spot. That's what I term by discretionary. It's almost bad as Elliott wave, right? So I think Elliott wave is the worst for that. It's just too discretionary. You know that joke. You get you put 10 Elliott wave analysts in a room, you're going to get 20 opinions, right? So it's for all instruments. It's just that it's a rule of thumb, right? So we're not saying it's like, hey, it's hard and fast, right? But watch price moving and see what you think, right? And people tend to have this thing about double zeros, right? It's a hard level, 120, 115, 110, and I've tended to find that you get more significant reactions at the threes and the sevens, right? So I'd kind of look 13 and 17 and things like, rather than to be looking at 10 and 15 and 20, right? And it's just like I said, rule of thumb, general observation. I've found it to be the case. Just see how the price reacts at around those levels, and you might arrive at the same conclusion or not. But the issue here was more about where do we expect price to stall and fail, and so a rule of thumb application is okay. The trigger condition is going to be a confirmation that the direction of the flow is changing, and so if she does rally up into that area, you want to see failure first. You want to see H4 bearish bars. You want to see a daily bearish bar, and a daily bearish bar. That's a good trigger condition, right? You take a trade after that. you chase it, and you could, if you're getting a follow through on a daily time frame, you're talking about picking up a lot of pips, right? So um, most of the time, it's just about being sensible in the application of a lot of these ideas, and being sensible about what constitutes a good trigger condition. Does it matter if the euro rallies aggressively towards that zone or gradually? It doesn't really matter to me. Because, look, once you've got a trigger condition, I'm not talking here about an aggressive entry, right? So I know usually I come on and I tend to have kind of very black and white, hey, short this wall, buy that wall. We're going to do that in a bit as well. But I thought we'd begin with Euro USD. We're not talking here about aggressive entries. We're talking about conservative entries with trigger conditions. And so even if she rallies really hard, you wait for a failure on a H4, you're good to go, right? And as well, the important thing is that when you've got failure off of a level where you expected the price to fail, it's good for defining risk. You can put a stop on the other side of that candle, and if the price is going and closing above that candle, then you know you're wrong, right? Because that bullish close will invalidate the bearish one. So, yeah, I'm not so concerned about how hard it rallies. And usually I like the hard rallies to these types of levels anyway. But I'm not really concerned about how hard it rallies. It's just a question of having vision that signifies failure. I think that's what's important. So, look, it's the same with that 112 block. If you get if you get H1, H4 close below that block, it means you're going to be looking for follow through to the downside, right? But if you're getting H1, H4 bullish bars off of it, that would invalidate the bear bias. The logic that gets you in, once that logic is invalidated, there's no reason to be holding onto that trade. Okay, failure on the H4 is more about how price closes relative to the level. Are you looking a specific candle pattern? No, just a bearish candle. You just want an indication that that the direction of the flow is changing. You don't want to be fighting it. And you mentioned that aggressive hard rally. If she does move fast like that up to the level, you want to wait for that rally to kind of finish, right? Before you start getting really excited. And if you want to be ultra conservative, you want to wait for a bearish day at least to confirm what you were thinking, because we're talking about a long way down on Euro USD. So, does it really matter if you missed the first 40 pips or 80 pips or the 100 pips of that, if it's going to happen, right? So, when you're talking about capturing a lot of pips, I don't think that really matters too much, right? But there you go. That's the Euro USD covered. I should quick look at GBP USD. I don't know if we want to. GBP USD, she's just rallying off the support wall. I've got nothing to say on that right now. We're gonna leave it alone for the time being and let her make up her mind what it is that she wants to be doing. The critical level for her is there, right? That's your kind of critical level. That comes in around about the 156 price handle. That's your yearly open price on the GBP USD. All right, that's the yearly open. So long as she remains below that, then the annual candle, the yearly candle, is bearish in direction. And if it happens that she's able to break above that and make a support structure, then maybe we will start listening to some of the noises coming out of the Bank of England over the weekend, suggesting that we are still very much on for a rate rise, either following the general election here, or certainly by autumn of 2015, around about October time, November time maybe. So headed into the close of the year. But as far as the overall direction is concerned right now, I'm just looking at flows, and those flows are being determined here uh, by the proximity of price to the 156 price handle. So long as she stays below that block, this is really important. So long as she stays below that block, it's a short, right? And if the direction of the candle changes, at that point, it becomes a long play. And I don't really have a technical on it right now. The last technical that we had was this wall. That wall held. She reacted quite well off of that. Now it's just a question of flow and just seeing the yearly direction and trying to stay on the right side of the yearly direction. So below 56, it's a short. Above 56, it's a long, and that's just based on the direction of the flow itself. All right, let's get on to some more hardcore technicals. Right, move on to something a little bit more hardcore. First up is the USD JPY. The only wall which I've got marked on the USD JPY, the important one which I'm considering, is this one. You can mark it something like this. If you want to mark something a little bit sharper, you can go something like that. And I've even seen people doing something like this, which I do like. I'm not against that idea. But what you have there, regardless of which one it is that you've chosen to mark, is a support wall. And that support wall represents the bull trend, or the overarching bull trend in USD JPY. And what I'm interested in on USD JPY is what happens when that bull trend fails, right? So what happens when that fails is a breach of the wall, pullback, you get a retest, and to the downside, it's kind of open territory, and it's open all the way down towards the 108, 107 price handle. So I'm really very much interested in a bearish outlook on USD JPY. It's a long-term outlook, and we're talking about a shed load of pips on it. But there's a trigger condition here, and really that trigger needs to be satisfied before we can get too excited about it. If you want to short before that, only casual positions, right? So small, insignificant positions that you're not going to lose sleep over if you get it wrong. But when you start off with a casual position and she goes your way and the trigger is met, and then you add on a little bit, that second trade is already paid for, right? Or at least the stop is covered on it. So it's not always a bad idea, but if you want to stay sensible, just wait for the trigger. So long as she remains above the 17 price handle, and so long as she remains above the wall, then you've got to consider that from a structural point of view, there's a support there, and so long as the support remains intact, structurally, the bulls remain in charge, even if the price is moving down towards that particular wall. Was the bounce at the yearly open a valid short on USD JPY, or was that too aggressive? I guess that that just depends on your own kind of trading style, right? So aggressive just means that you would have gone at market, and conservative means that you would have waited for a confirmation or for some kind of trigger condition to be met. But we can take it as an example, right? So if you were going to short this instrument at the yearly open, there's a H1, you would have waited for that close on that bearish candle. If you were going to be a little bit more conservative than that, you would have waited for a close on a H4 candle, and that would have kept you out of trouble here. But at the same time, it would have given you an entry here, right? And you would have looked to follow that through to the downside. So this is what I mean when I talk about, if you're getting a bull close up through the level, you might look for the long trade, and you might have done that there, right? Or you might have waited for a pullback. But equally, when you get that bearish close down below that level, your expectation would be that the price is going to follow through in the direction of that candle. So this could have given you actually quite a reasonable trade on the H4. Alternatively, what you might have thought was, why don't I just mark a trend wall? And the breach of that trend wall would become the trigger condition, right? So that yearly level is important, absolutely. It determines the direction of the flow on this instrument, but you have to devise the trigger conditions, and it's those trigger conditions that keep you safe and keep the money on your account. So if you're sensible with the trigger conditions, it will keep you out of a heck of a lot of bad trades, right? So I think that is very much the key. But as previously mentioned, I'm kind of on the daily time frame here with the USD JPY, and to me, it's about that support wall right now. That's what the USD JPY is about. I can see her much lower, but I'm not going to try and get on board with that unless that support is reached. That is all important to me, and otherwise, she could just move higher, right? There is a structural support there. I don't want to be fighting that right now. I'm not really seeing cause to. There are some yen crosses where I'm seeing cause to. I guess we'll come to those. All right, let's do that now. All right, let's do that now. All right, so next up then is the Euro JPY. Euro JPY, we've already committed to short positions, so we've been in shorts from last week on the Euro JPY. It's published in my trade notes last week. A couple of walls which I'm looking at on this particular instrument. So first up is this one. You mark that one like that, and as well there's this one like this. And my advice to you would be, if you see a rally in the Euro JPY up towards that wall, to sell it. If you see the instrument breaking down, you're not already involved in a short, but if you see the instrument breaking down below our weekly open here, right, and you're seeing her breaking down, then just try and follow that momentum with casual shorts after a bearish bar. And if you're doing that while the price is below the weekly open, price breaking up above the weekly open would invalidate it, right? So you know how you're going to have to position your stops. But what I'm thinking about the Euro JPY is that so long as the wall holds now, she's a short, and we really want to see her breaking down through the 32, through the 30, and over the course of the coming months. We're going to be talking 125, 126, 127. There's the 7. I thought I should get it in there, right? But we're going to be talking round about that price area for the instrument. So I think that there is, there's like 1,000 pips to the downside here on Euro JPY. It's worth more than one attempt. It took us more than one attempt to get involved in that last week, but we've got reasonable entry, and just going to be looking for the instrument to break down. That's the technical, right? So this is the wall now, which actually defines it, and a secondary. There's a secondary wall there, which would also be a short trigger for us, but short bias on Euro JPY. It's a kind of setup that I'd be looking for a swing off of, and so long as she remains below 137. And I think this is actually a good example of what we were talking about earlier. Right, so she fell just before the 137. She fell at 36.66, right? And that's where she failed. Um, just ahead of the 137 price handle. Good enough for me. Um, so downside on Euro JPY, and there's the support resistance walls. Summer, I don't have any technicals on GBP JPY. That chart is looking something like this right now. As you can tell, I was trying to figure stuff out on it, but I haven't figured out anything on her right now. So I'd leave it alone for the time being. I'd rather work with a pair where I've got clean technicals rather than try to work with something where I haven't. So that wall can go, even that wall can go. What's the most you could be doing here, right? You could be looking at this one and saying support becomes resistance at that block. Could be looking at something like that, right? And so long as she stays below that block, it's a short. If she breaks up above it, then it becomes a long, and that long would probably correspond with the yearly open, right? So, look, I've got nothing on this. I've got nothing on this, right? If you are looking for a short trigger, you might just want to mark a wall. That wall's been breached now, so that would mean a short at market, and you'd probably be marking your stop somewhere above 83.60, which is quite a large stop. Yeah, that's the size of that stop would concern me itself. But I've got nothing on that. The cleaner technical is on Euro JPY, so stick with that for the time being. Where else do we want to take a look at? Dollar Canadian, right? So this is the support wall on the dollar Canadian. You really want to have this marked on your charts. Okay, that's the support wall, right? And again, bull bear bias based on bullish and bearish candles off of it, right? So you got a bull H1 bar, buy, look for further upside. If she breaks down through it, you've got a bearish H1 bar, sell and look for follow through to the downside. And you can either chase that or wait for a retest, right? If you're looking for a sharper entry, but she's at that place. She's at that place. It's decision time, and bullish bars off of it means support. Look for further upside. Bearish bars, look for further downside. With these types of walls, I tend to prefer playing the breaches rather than playing it holding. But considering the recent strength in the US dollar, we've no reason to believe that that strength is expiring until it does, right? So right now, that would be a bullish call on dollar Canadian, and you get a bearish bar breaking down below that, you know what to do. And it's worth 2 or 3 attempts, but once you're getting a follow through to the downside particularly, I don't think you can rule out a retest of the 118 price handle, which gives you about 600 pips to the downside, right? So, this is how crazy I am. There's not one time that I come here on FX Street to do a presentation and I'm always talking about 1,000 pips this way, 2,000 pips that way, 800 pips this way. But there you go, right? 118 to the downside, right? So there's at least 600 pips here to the downside. And the trigger for that would be a breach of the wall, right? So H1, H4 below that, look for follow through, right? And, if you're aggressive, just do it on the breach. If you're a little bit less aggressive, wait for the hourly. And if you're in pure conservative territory, then look to follow a H4 or a bearish daily close, and you should be good all the way down to 118, provided you apply those types of trigger conditions. Let me tell you what I'm really excited about right now, right? is GBP AUD, right? So GBP AUD is a short, and it's a short at market, and it's a short even if she rallies all the way to the high. Okay, but GBP AUD is a short, and we're going to come back in a while. We're going to come back in a couple of weeks, and the price is going to be at the 89, 88 price handle, right? That's where the price is going to be. Maybe she even pushes as deep as 87, giving a clean 1,000 pips to the downside. So GBP AUD is a short. I'll say it again. Short. Do not be doing anything other than shorting GBP AUD until you're kind of given reason to do otherwise. So what we're looking at here is probably one of my favorite all-time trade setups, although it doesn't occur half as often as it used to a few years ago. But anyone know what this is? You know what we call this? Right? There you are. That's it. Right? So that there be a sine wave. And a very, very clean strike there. Right? So we have our strike price. And what we're saying is that so long as the price remains below that strike price, right? So we're kind of privileged enough to have done this last week and initiated our short plays. But so long as the price now remains below the strike price, technically, even if she rallies up to that level, even if she pushes a little bit through it, once she falls back under it, it becomes a trigger for a short. So it's a short all the way up to it. It's invalidated above it, but if she falls back under it, it becomes a short again. And to the downside, we're looking at certainly sub 90, right? Certainly sub 90, we're looking at GBP AUD. So when I start thinking about adding shorts, once the price has fallen a little bit further, so I guess the way to do it is just let her drop a couple of 100 pips. And the monthly is at 93.40. So once she falls below 93.40, I think that really opens the gates. And I know it's on, it's just still a couple of weeks left to go, right? So we still have good 2 weeks clean trading for the month of February. It can happen. It can happen. So 93.40 is the monthly. And once the price is able to breach that, that will open a door to sub 90s. All right, GBP AUD, it's a short play. You heard it here first. And if I've got it wrong, I hope you all have short memories, right? But I'm liking this one. I think it has a decent target to the downside, and the R&R really kind of makes it worthwhile pursuing that. It's just going to be about getting a good entry, and if you're not sure you're going to be able to get a good entry, just take a casual position, right? Go a fifth or a third of your regular position size, and if the position starts moving in your favor, you can always look to start adding on a little bit later and then chasing the bearish days. So you just add at the end of every bearish day, and that tends to be a pretty good strategy overall when you're trying to build a position. This daily chart is just a prime example for it. But if you're doing that, chasing the bullish days and just adding at the end of a bullish bar, you kind of get the idea, right? So we think the instrument's going to collapse, and we'll just add a little bit at the end of bearish bars, building a position until she reaches our target, which, as I mentioned, we're talking about the 89 price handle, certainly to the downside on this instrument. Okay, last one up this morning, which I want to open up some thoughts about, is NZDJPY. So this is the NZDJPY. She has been humbled a little bit this year. She collapsed to the tune of about 900 odd pips. Who would have thought? So and we're kind of getting a rally now back up towards the yearly. And what I'm thinking here is that there's a bit of a nose pattern going on here, right? So there's the nose, right? And you might call that an ugly double top. Um, but that's the nose there. Now, the only trouble I have with this nose is that she kind of extends all the way up towards the 92 price handle. But this is something to monitor over the coming weeks. You know, we see the price push into that price handle and you get some consolidation there. If she can stall here for a lengthy period of time, she might stall there for a week or a month. She might even stall there for a quarter, right? But if she can just stall there, I think that after that stall, what you're going to get is a very rapid fall, right? So, you know, my analysis is rhyming today. That's how good this analysis is. It actually rhymes. After that stall, you're going to get a fall, and that's what I'd be looking out for on the NZD-JPY. I do not think that Kiwi weakness is done yet. All right, I don't think it's done yet. It's just a question of where and when that next swing begins, and with this particular instrument, I'm going to be looking at that nose level, looking for a rally up through the 90, and if she can stall in that area, I'd keep an eye on that. And the longer she stalls, the more I would be prepared to kind of build positions in that range, even if it was a wide range. So even if it was 150 pip range stall, I'd start building positions in that 150 pip range, preparing for a significant drop after that. So is a price action issue here. We want to see the price behaving in a very particular way. And if she starts behaving like that, I think we can start getting excited about the downside on this particular instrument. If she just moves straight through the block, you kind of got to leave it alone and just let her and let her do that. So you know, she's clearly moving north right now. I don't want to get in her way until I have a precondition or a reason to do so. So if she's moving north, I'll let her, right? If she's moving north, let her. But if she reaches the nose and she stalls inside of that, I think there will be some interesting potential there for trade, and I'd want to keep on. I'd want to keep my eyes on that and monitor that, right? So that's the NZD-JPY covered. Okay, folks, that's your lot. I think that's everything I wanted to discuss. There's something there about Aussie Kiwi. Do you trade Aussie and Kiwi as well? You mean AUD USD? I do, but I don't have a technical on the Aussie right now, so I'm kind of sitting aside as far as the Aussie dollar is concerned. I do very much suspect that AUD USD is going to move higher, but it's more of a suspicion right now. From a technical perspective, you've just got to look at the last few SR areas. So, you know what? Look, you've got support turn resistance there at 78.80 price handle. And so you'd say from a technical point of view, so long as the price is remaining below resistance, the bears remain in control. But what happens if that's breached, right? And maybe you might start seeing something like this. It's a suspicion I have, but I don't have a technical. GBP AUD, we have a technical. And if GBP AUD is going to fall, you know, that could be a product of pound weakness, or it could be a product of Aussie strength. And so I can imagine that being a product of Aussie strength, right? So that's okay. As far as the Kiwi dollar is concerned, I'm strictly on a daily time frame here for the Kiwi dollar, and again, The yearly there was around that 77, 78 price handle. It was 77.90-ish. So it's got that 78 price handle. We've got on the yearly on NZD, and I think if she's pushing back as far as that, that would be quite something. Um, there might even be a kind of support resistance wall you could mark here, maybe something like this, right? So yeah, you'd be looking for failure 76, 77 price handle, but you'd want that to be confirmed, right? So you want to see H1, H4 failure, and uh, my suspicion is that we're going to get a stall before the next fall. That's my suspicion. So the NZD seems from a structural point of view, the easier one to assess, right? So we've got a pattern here that we recognize, and if we get the stall there, it just acts as a confirmation. I don't have that on NZD. I just have a general bias, but I don't really have a technical, which is why I've kind of steered clear from that today. Uh, Right, folks, that's your lot. Thank you very much for attending this morning. I'll be back here probably the first week of March. And if you like what you've heard, don't forget to check out my website. It's www.wmdforex.com. You can subscribe there and access my analyses every week. Thanks to the team at FX Street, as usual, for providing the platform, and you guys for taking the time to hear me out. I'll see you all the next time. Cheers, fellas. Bye bye.